303 billion barrels. That's the size of the prize at the center of what just unfolded. One country sitting on the largest proven oil reserves on the planet, larger than Saudi Arabia, larger than Russia, has suddenly become the focal point of a global power shift. And whether you realize it or not, this moment has nothing to do with headlines, politics, or morality. It has everything to do with money, energy, and control. Over the past 2 decades, trillions of dollars in potential oil wealth inside Venezuela remained effectively frozen. Not because the oil wasn't there, but because the infrastructure collapsed, investment vanished, and foreign companies were locked out after the industry was nationalized. What you're watching now is the breaking point of that system, and what happens next will directly affect how much you pay at the pump, how stable your retirement account is, and whether the global economy moves toward expansion or slips further into stagnation. Here's the reality most people miss. Today, Venezuela produces roughly 1 million barrels of oil per day. That's a shadow of what it once produced in the 1990s, when output exceeded 3.5 million barrels per day. More than 2 million barrels of daily capacity sit idle. Not because demand doesn't exist, but because refineries have deteriorated, pipelines are outdated, wells are offline, and decades of underinvestment hollowed out the entire system. You'll hear promises about massive capital flowing in, about international energy companies returning, about production roaring back. But this is where fear should replace optimism. Restoring Venezuela's oil sector isn't a short-term project. It's a 10-year process at minimum, requiring well over $100 billion just to bring output to a fraction of its former peak. A full decade. And during that decade, the economic shockwaves won't stay contained. They'll move through every major market on Earth. Geopolitical tension is already embedded in the numbers. Major global powers have billions tied up in Venezuelan oil-backed agreements. When political control becomes uncertain, those agreements don't just weaken, they become leverage points. And when leverage shifts, retaliation follows, not necessarily through tanks or missiles, but through financial pressure, currency moves, trade realignments, and capital flows. At the same time, energy markets are about to confront an uncomfortable truth. Venezuelan crude is heavy, complex, and not easily replaced. Even if producers wanted to substitute it overnight, they can't. Refinery configurations, transport logistics, and blending requirements make that impossible in the short run. In this video, I'm going to walk you through a 4-stage pattern that repeats every time a major oil-producing nation goes through forced political disruption. Then, we'll map current data onto that pattern, step by step. By the end, you'll understand why the outcome isn't a smooth recovery, but a fork in the road where prices either collapse or explode, portfolios suffer either way. And the next 18 months quietly decide whether the United States strengthens its position or accelerates a long-term decline. This isn't guesswork, it's pattern recognition. And right now, we've just crossed into stage 2. Here's how the pattern works. Every major regime disruption in an oil-rich country unfolds in 4 phases. Stage 1, intervention. A powerful external actor decides that changing leadership serves its strategic interests. The public justification varies: security threats, corruption, human rights. But the outcome is the same. Force is applied, the existing government collapses quickly, and promises are made about rebuilding, stability, and reform. International criticism flares, allies hesitate, rivals protest. But the initial objective succeeds. Stage 2, chaos. And this is where reality sets in. Removing a government is easy. Running a country is not. Authority becomes fragmented. Competing factions claim legitimacy. Infrastructure deteriorates because no one is clearly responsible for maintaining it. Investment freezes, capital exits. And oil production, an industry that depends on continuity, technical expertise, and constant reinvestment, starts to fall apart. When leadership changes violently, contracts lose clarity. Companies don't know who has legal authority. Workers don't know whose orders matter. Engineers leave. Equipment fails. Output drops. Revenue collapses. And once revenue falls, the system spirals. Services break down. Unrest spreads, and instability feeds on itself. That mechanism is not political. It's mechanical. And it plays out the same way every time. When systems start to break, they don't fail gracefully. Equipment degrades, output slips. And once production declines, revenue follows almost immediately. When revenue drops, governments lose the ability to pay workers, fund basic services, or maintain order. Social pressure builds, protests spread, capital flees, and the process feeds on itself. This isn't ideology, it's math. That spiral pushes the country into the next phase. Stage 3, the resource bargain. Eventually, whoever consolidates power faces the same problem. There's no money, so negotiations begin. Access to reserves is offered. Profit-sharing agreements appear. Contract terms suddenly become very generous. Foreign companies bring capital, technology, and expertise back into the picture. Production begins to recover, but never at the pace promised in press releases. Why? Because rebuilding oil infrastructure is slow, Damaged refineries don't restart overnight. Skilled workers don't reappear instantly. Trust between governments, companies, and labor takes years to rebuild. And while that slow recovery is happening, geopolitical rivals don't sit quietly. They apply pressure. They back opposing factions. They use sanctions, trade restrictions, diplomatic leverage. The country becomes a proxy arena for competing interests. And oil output stays constrained far longer than markets expect. Then comes the final phase. Stage 4, the new equilibrium. After 10 years, sometimes 20, a new normal forms. Production stabilizes, but rarely returns to previous peaks. The country is permanently altered. Wealth has shifted hands. A small group benefits enormously, usually those who entered early. The majority is left with less. Global energy markets adjust to a structurally lower supply profile. Prices reflect that reality. Alliances shift. The cycle closes until the next intervention begins it all again. Intervention, chaos, resource bargaining, new equilibrium. This pattern has repeated for decades, not once or twice, but consistently. Let me show you how it unfolded in the real world. Take Iraq from the early 2000s through the mid-2010s. The initial intervention unfolded quickly. Military objectives were achieved in weeks. Leadership collapsed. A new administrative structure was installed. On paper, the transition looked decisive. But stage 2 followed immediately. Institutions were dismantled faster than replacements could form. Security deteriorated. Infrastructure suffered. Oil production, which had been running at roughly 2.5 million barrels per day, dropped sharply within months. Pipelines were disrupted. Refineries were damaged. Skilled personnel left. Investment vanished. Violence escalated. For years, production couldn't recover, not because the oil wasn't there, but because stability wasn't. Stage 3 emerged only after prolonged effort. As security conditions improved marginally, international energy companies cautiously returned. Contracts were signed, capital re-entered, but recovery was slow. Nearly a decade after the initial disruption, output still hadn't sustainably exceeded pre-crisis levels. The cost, financially and socially, was staggering, and the country entered a long, fragile stabilization rather than a true recovery. Today, Iraq produces more oil than it once did, but that outcome took 2 decades, enormous external involvement, and deep structural damage. The 4-stage cycle played out in full. Now consider Libya after 2011. The initial intervention removed centralized authority quickly, but what followed wasn't transition, it was fragmentation. Multiple power centers emerged. Control over oil infrastructure shifted constantly. Production collapsed by more than 80% at one point. Even years later, output fluctuates wildly depending on which faction controls which facility. Stage 3 arrived, but in a fractured form. Stage 4 never fully materialized. The system stalled in instability. Different countries, different decades, different justifications, same underlying mechanics. And this is why understanding the pattern matters more than reacting to headlines. Because once you recognize the sequence, you can anticipate what comes next, long before markets fully price it in. In Libya, the second stage arrived instantly and violently. Central authority collapsed almost overnight. No unified government. Armed groups filled the vacuum. Power fractured across regions. What had once been a functioning oil state split into rival centers of control. Production didn't decline gradually. It collapsed. Output fell from roughly 1.6 million barrels per day to barely 200,000. An 80+% drop. Pipelines were seized. Export terminals shut down. Foreign engineers evacuated. Skilled labor disappeared. And the chaos didn't pass in months. It dragged on for years. Between 2011 and 2016, Libya's oil sector barely functioned at all. The country slid into civil conflict, and energy infrastructure became a bargaining chip rather than an engine of recovery. Stage 3 eventually emerged, but in a distorted form. Around the late 2010s, temporary ceasefires allowed production to rebound toward 1 million barrels per day, but stability never followed. Output swung wildly, up one month, down the next, depending on which armed group controlled which field or terminal. Foreign operators returned cautiously, working under constant threat. The National Oil Authority attempted to coordinate exports, but with limited enforcement power. The resource bargain existed, but it was fragmented, unstable, and constantly renegotiated. Stage 4 never arrived. More than a decade after intervention, Libya remains divided. Political authority is weak, oil production stays far below potential. The system never stabilized. This is the worst-case outcome of the cycle. Intervention without consolidation, chaos without resolution, and production that remains structurally suppressed. The pattern unfolded, but stalled before equilibrium could form. Now, step back further in time. Iran in the mid-20th century followed the same sequence, just compressed differently. The initial intervention succeeded quickly. Political control shifted. Oil production resumed under leadership aligned with foreign interests. Contracts were signed. Output expanded. On the surface, the transition looked orderly. But beneath that stability, resentment accumulated. Oil wealth flowed outward, benefits concentrated among foreign firms and domestic elites. The broader population saw little improvement. Over time, political repression intensified. Economic imbalance hardened into social anger. Stage 3 played out in reverse. Instead of gradual stabilization, pressure built for decades until it detonated. The late 1970s revolution expelled foreign companies, nationalized energy assets, and severed existing arrangements overnight. What followed was Stage 4, a new equilibrium defined by isolation, sanctions, and permanently reduced output. Even today, production remains far below its historical peak. The intervention decades earlier set off a chain reaction that reshaped the country's trajectory for generations. 3 cases, different eras, different narratives, same underlying structure. Intervention, disorder, resource renegotiation, a new diminished balance. And this brings us to the present. Now let's map that framework onto Venezuela, not hypothetically, but in real time. The first stage has already passed. Leadership was removed, control shifted. The formal announcement of transition marked the end of the initial phase. But history tells us that Stage 1 is never the part that determines outcomes. Stage 2 is where everything becomes uncertain. Right now, authority inside Venezuela is fragmented. Competing claims of legitimacy exist. Governance structures are unclear. Control over institutions, especially the energy sector, is unresolved. When clarity disappears, decisions stall, contracts freeze, investment pauses, even basic maintenance gets deferred, and the production numbers reflect that vulnerability. Venezuela currently produces around 1 million barrels per day, down from 3.5 million decades ago. More than 2 million barrels of daily capacity sits idle. Refineries are outdated. Infrastructure has suffered years of neglect. Restarting that system isn't a switch. It's a reconstruction effort measured in years, not months. This is the point in the cycle where expectations and reality diverge the most. Headlines promise recovery, markets speculate on future supply. But history shows that during Stage 2, production often falls further before it ever rises. And what happens next, how long this phase lasts, and how it resolves, will determine not just Venezuela's future, but how global energy markets adjust in the decade ahead. Rebuilding Venezuela's oil system isn't a matter of flipping a switch. It is a balance sheet problem measured in tens of billions. Internal estimates from the state producer suggest that upgrading pipelines alone would require roughly $58 billion before a single well is fully restored. Getting production back to even 2 million barrels per day would likely demand a decade and well north of $100 billion in total investment. Independent analysts who study Latin American energy systems have been consistent on this point. Timelines are long, costs are higher than advertised, and setbacks are inevitable. And here's the trap most forecasts ignore. During those 10 years, output often falls before it rises. Political uncertainty drives experienced workers out. Equipment fails faster than repairs can keep up. Maintenance is delayed. Sabotage and disruptions become more frequent. History shows that the chaos phase almost always produces additional declines before recovery even begins. Look at the current operating reality. Roughly a quarter of Venezuela's existing output, about 250,000 barrels per day, comes from operations involving Chevron, which remained active under special licensing during sanctions. Beyond that, the field thins out quickly. ExxonMobil exited years ago after nationalization, later winning arbitration awards that were never meaningfully paid. Other international firms followed similar paths, leaving behind unresolved claims worth billions. Those memories matter. Capital doesn't forget being burned. So when political leaders say major American companies will come back in, the question isn't enthusiasm, it's conditions. Investors require legal clarity, enforceable contracts, political stability, and credible profit structures. None of those elements exist in full today. That means investment is likely to be cautious and delayed. And as long as capital hesitates, production remains constrained or slips further. This is where the situation turns into a geopolitical powder keg. Major powers are deeply exposed. China extended tens of billions of dollars in loans over the past decade and a half, secured by future oil deliveries. Russia has joint ventures tied directly to Venezuelan fields. If existing agreements are rewritten or voided, losses would be severe. If they're honored, access for new entrants becomes limited. Either way, this is a zero-sum negotiation. Someone absorbs the damage, and history suggests the losers don't stay passive. Official responses are only the surface layer. The more consequential retaliation tends to be economic. China remains one of the largest holders of U.S. Treasury securities, though its exposure has been declining for years. Accelerated selling wouldn't be symbolic. It would pressure bond prices, raise yields, and push borrowing costs higher across the U.S. economy. Russia's leverage is different. Energy flows, regional influence, and asymmetric pressure can all be deployed to raise the cost of prolonged instability. And beyond the major powers, the rest of the world is watching. Most countries aren't aligned firmly with Washington. They're neutral, hedging, or drifting toward alternative blocks. What they see is precedent, resource-rich states becoming vulnerable when control is contested. That perception alone weakens trust in the dollar's neutrality and accelerates efforts to diversify trade, settle transactions in local currencies, and reduce dependence on a single financial system. This isn't ideology, it's risk management, which brings us back to stage 3 of the cycle. The resource bargaining phase has already begun in principle. Public statements promise investment, reconstruction, and rising output. But the real negotiations, contract terms, profit sharing, legal protections, will take months or years. If terms tilt too far toward foreign firms, domestic backlash grows. If they don't tilt far enough, capital stays on the sidelines. During that limbo, production remains depressed. Meanwhile, instability creates openings. Neighboring states prepare for spillover effects. Regional powers position themselves as mediators. Economies that depended on subsidized energy supplies face sudden shortfalls. Migration pressures build. None of this boosts oil output. All of it complicates recovery. This is the uncomfortable middle of the cycle, where expectations race ahead, but reality moves slowly. The regional consequences don't stop at borders. Economic pressure radiates outward. Neighboring economies feel the strain. Migration patterns shift. Entire regions destabilize, not overnight, but steadily. And while that human impact unfolds, markets begin doing what they always do, repricing risk. So what does this actually mean for oil? In the very short term, surprisingly little. Venezuela currently contributes about 1 million barrels per day to a global market producing roughly 100 million. On paper, that's just 1%. But markets don't move on today's numbers. They move on future constraints. The long-term picture is where the pressure builds. If Venezuelan output remains stuck near current levels for the next decade, that effectively removes over 2 million barrels per day of potential supply that markets once assumed would return. Prices don't collapse in that environment. They drift higher than they otherwise would have. And if production slips further during the chaos phase, which history suggests is common, even the existing output becomes vulnerable. Lose another few 100,000 barrels and the balance tightens fast. Can others step in? Not easily. OPEC has little incentive to flood the market. They benefit from higher prices. U.S. shale can respond, but not instantly. New wells take time to finance, drill, and complete, often 12 to 18 months. That leaves a window where supply is tight, inventories matter, and any external disruption sends prices sharply higher. Stage 4, the new equilibrium won't arrive quickly. Based on past cases, it's measured in decades, not years. Eventually, Venezuela may produce more oil than it does today, maybe 2 million barrels per day, maybe more. But that outcome requires sustained investment, political stability that doesn't yet exist, and resolution of competing claims involving China, Russia, and Western firms. Until then, uncertainty dominates. When equilibrium finally forms, the wealth transfer will be substantial. Early entrants with capital and leverage will capture outsized gains over time. The local population may see improvements, but a significant share of value will flow outward. Energy markets will have adapted to a different baseline. Alliances will look different. Trust in financial systems will be more fragmented. This is where objections usually surface, so let's address them directly. First, this will bring democracy. That framing ignores history. Political systems don't mature through external force, they evolve internally, over generations. Interventions tend to produce instability, extraction, and resentment long before they produce accountable governance. Second, oil prices will crash once new supply comes online. That assumes recovery is fast. It isn't. Even optimistic scenarios place meaningful production growth a decade out. During that time, prices are more likely to be higher than lower, not because of shortages today, but because of uncertainty tomorrow. Third, investment will surge because reserves are enormous. Capital remembers risk. Past expropriations, unpaid arbitration, and shifting legal frameworks don't disappear. Investors demand guarantees that are difficult to enforce in transitional environments. That slows capital deployment and delays recovery. So what does all of this mean for you? There are 3 realities worth understanding now. First, energy costs remain volatile and elevated. Prices may spike if production falters, or stay elevated if markets believe recovery is slow. Either way, fuel costs are likely higher than they would have been. Planning matters. Efficiency matters. This isn't a one-quarter issue. Second, geopolitical risk has increased meaningfully. Retaliation rarely looks like open conflict. It looks like financial pressure, currency diversification, and shifting trade relationships. That feeds directly into interest rates, mortgages, credit cards, business loans. If demand for sovereign debt weakens, borrowing costs rise. That's not theory, it's mechanics. Third, portfolios built for stability are exposed to instability. Equities assume growth. Bonds assume trust in currency and institutions. When both assumptions are questioned at the same time, diversification within paper assets loses effectiveness. Assets tied to physical reality, energy, commodities, real resources, behave differently in these environments. They're volatile, but they retain relevance when systems shift. This pattern has repeated for over 70 years. Different countries, different narratives, same sequence, intervention, disruption, renegotiation, a new balance. We're at the transition point now, where expectations race ahead, but outcomes remain unresolved. Oil production won't rebound quickly. Geopolitical responses won't fade quietly. Markets will continue repricing a world where power, resources, and trust are being renegotiated in real time. If you want to follow how this unfolds, the next step is timing. When supply tightens further, when prices react, which players benefit, and where the pressure points emerge over the next 18 months. After that, the conversation shifts to currency. How confidence erodes not through competition, but through precedent, and why purchasing power can fall even when inflation headlines stay calm. The system is already in motion. The adjustment is underway. And whether the outcome feels sudden or gradual depends entirely on whether you see the pattern before it becomes obvious. The question isn't whether change is coming, it's whether you're positioned before the market fully prices it in.